having your right financing structure from day one is really important for tax effectiveness, making sure you've got the most tax deductible when you're buying investment properties or shares or managed funds. It's the purpose of what you're using that money for. And we also want to take control of that money. That money is your money. Have you ever felt like the bank's taking control of you, all right, and you're constantly having to pay that money out every month to pay your loan off? You've got your credit card there. How about you take control of your money and have access to your money when you need it? A line of credit and an interest-only loan, we do recommend them for investment purposes and also for your own occupied loan, because when you're paying off your loan, you're paying back and giving equity back to the bank. We want that equity to be used by yourself when you're investing, to be able to have more cash flow available to you to purchase more assets that are going to appreciate in growth faster than you'll be able to save that money. Right? So taking control, why a line of credit is important is it allows you to maximise the money that you can pull out and only pay the interest that's due on that. All right? So long as we're buying accumulating assets that are going to grow with that money, all right, it's going to outweigh the benefits of the cost of not paying down that loan. Other people's money, in the wealthy use other people's money to get wealthy all the time. They don't use a lot of their own money. They find deals in where they might do joint venture deals, right? Where the biggest thing that we think of other people's money is the bank. We go to the bank, they lend us the money. If we're going to the bank and we're getting a 90% loan, then someone is providing us 90% of the funding for that property. How good is that? You've only got to throw 10% into this deal. I think it's fantastic. You know, what using other people's money allows us to do is obviously buy more properties. Can you imagine trying to find $400,000 to buy your first property with? You know, how long is it? You might take 60 years when you retire and 60, be able to have cash to buy that property that's now worth, you know, $1.2 million. So you'd never actually get into the cycle of buying the assets and buying those properties. So we need to use other people's money and we need to leverage other people's money. And part of that is also by paying lenders' mortgage insurance. Now, I'm not adverse to paying lenders' mortgage insurance. I think, yes, it's an insurance that covers the bank, but I think, great, it's an insurance for me that I have to throw in less money into the deal. All right, so I can go out and buy 2, 3 properties rather than just buying one property where I may have to throw in 20% deposit into that so that I don't have that mortgage insurance fee that I've got to pay that you may have all heard about, and especially if you're going for a 95% loan or a 90% loan. LVRs are loan to value ratios, all right? It's when we've got a loan, so a 90% lend on a loan is a 90% LVR. Now that's a little bit of terminology that we'll all start to speak, and as a person that wants to learn about wealth creation, that'll start to sing through your body. It'll flow like blood. What's the LVR going to be in that property? How much can I get for that? So the LVR is learning and talking about how we used other people's money with that LVR. And you know, if we've got a 90% LVR, then we're using someone else's money for 90% of that. So a lot of the banks will talk about 80% LVRs because you don't have that mortgage insurance. All right, there were 100% LVR loans back about 6 months ago. That's probably what got the economy a little bit, or especially in America, a little bit into trouble. So, you know, the banks have pulled that back a little bit. I think that's a good thing. It means that people have to save a little bit of money to get into some of these deals. There is another way to buy property, and a lot of wealthy people understand these, and it's flowed through their families, and they talk about these structures. You might have heard about family trust structures, companies, or companies as trustee for a family trust, hybrid trusts, all right, unit trusts. These are all different structures that you can use to purchase property in for different reasons. Now, you can also buy it in your own name, yes, and you can get tax deductions against your own name if you're purchasing that property. However, it depends on what you're looking to do with that property in the end. How long you're going to hold it? How much profit do you expect to make from this property? Where's the cash flow going to be derived or paid to out of it? So everyone's a little bit different, and that's where we personalise and talk to you about your own needs on what you need, whether or not you need a trust structure. If you're self-employed, you may want another level to your structures, so that if you were to get sued, then you wouldn't lose those assets in properties because they're protected under a company trustee structure over a trust. Alright, that does get a little bit complicated, guys, and I would like to talk to you guys more in person on a one-on-one on your own needs when we're talking about those things.